Hello, everyone. Welcome to our latest episode of The Pitch. My name is Dave Keller. I'm the Chief Market Strategist at StockCharts.com. It's a lot of fun to work with all of you to try to help you make better decisions using the best practices of technical analysis. But one of the things I truly enjoy about being at this role in StockCharts is being able to work with some really talented strategists and commentators and traders that can lend some of their expertise. And we have three really fantastic guests today to help us make sense of the pitch. I want to welcome each of you on, and thank you guys again so much for joining me in a volatile week among very volatile weeks. I feel like we have John Kosar. John's the Chief Market Strategist at Asbury Research, coming to us from Chicago. Jeff Hughes is the Chief Investment Officer at JKHY Investment Partners in Minnesota, and we also have Julius de Kempenaer, creator of the RRG, the Relative Rotation Graphs, founder of RRG Research, coming to us from the Netherlands. Guys, welcome to all of you, and thanks so much for joining me today.
Good to be here.
You're welcome, Dave.
So just so you guys know what to expect, we are going to have each of our three commentators present to you with 5 pitches, 5 stock and or ETF ideas. We will bring up their charts. They'll be able to address them, talk through what they're thinking, how they would approach it, and why they think it's an actionable idea right now. After we go through all 15 of those picks, we'll recap them for you and remind you what everyone picked. And then second half of the event will be all about a discussion. We'll sort of talk through them as a group and sort of try to make sense of all of these different names relative to the big picture. Obviously, pivotal market moment with the S&P rallying, the NASDAQ rallying as well in recent weeks, right up to a pretty key resistance level around S&P 4,200. So let's get to our picks. John Kosar, we're going to start with you. You're at Asbury Research in Chicago. You're a frequent face and voice on StockCharts TV, and we really appreciate it. As you were getting ready to pick these 5 stocks, was this more or less challenging than normal, or was this sort of business as usual? It's always tough to pick stocks.
I think it's the latter for as far as I'm concerned. What I tried to do is I tried to pick stocks that we are already watching and have shown our subscribers over at Asbury. So it wasn't like I went and tried to find 5 new ones. I tried to find 5 solid ideas that we have liked for more than just a few days, and that had a lot of structure to them that would show well on the charts. So hopefully they will.
Perfect. Let's get to your first pick, which is a name some may not be familiar with. It's Arcos Dorados Holdings, ARCO. Talk us through this chart if you could.
Sure. Let's look at the top first. And we've got a daily chart here that goes back to August of last year. The orange line is the 200-day moving average. That's the major trend by most people's standards, I think. The 50-day is the minor trend. So July 18th is when this showed up on our scans. We have a scan that we do on 6,000 stocks and a couple of hundred ETFs. And this turned up. One of the reasons that it turned up is the stock market goes up most of the time. So getting the direction right is not hard. The hard part is where you put them on and where you take them off. So this started showing some strength around the 200. And then you can see right down, if you go straight down, this is a relative performance chart versus the S&P 500. You can see it started to hold that May 9th extreme and underperformance, and then it started to move higher. And then it kind of kicked into second gear on July the 28th when it broke through the 50. So now we held the 200, major trend is still good. We broke the 50. We have a minor bullish trend change. And now look what's happening downstairs here. We are starting to break out of this important March 1 peak in relative outperformance. So you've got all your cylinders clicking here. It looks like we're going to retest the highs.
It's a nice improvement in price and relative. I really appreciate you going through that one. Jeff Hughes, welcome to the show today. How are you navigating these markets? Is the a bear market phase like we've been in 2022 a fun time to be doing what you're doing, or a challenging time, or a little of both?
Well, first of all, thanks for having me on the show, David. And in answer to your question, I would say that it's no more fun or less fun than any other market. It's just simply trying to identify the major trend and stay on the right side of it. To quote Marty Zweig, that's how the big money's made. The rest of it is just circumspect. And so with respect to trying to identify the right stocks to be in, that's what we spend most of our day doing every day, is just seeking out these stocks that have the potential to drive strong relative performance.
Jeff, I tried to goad you into giving some emotional answer, but like a professional, you responded with, let's focus on the evidence. Let's look at the charts. So let's get your first name, ELF Beauty. Talk us through this one.
Yeah, it's a cosmetic maker out of Oakland, California. The company's only been public since, I believe, 2004. Stock made a new all-time record high yesterday. They reported a beat and raise quarter last night. The stock's gapping up today nicely. In our opinion, this resolves a deep cup base that really dates back about 7 months or so. It's above its faster moving and intermediate term moving averages, which are now turning up. So the trend is definitely to the upside. If we look at the upper frame of this chart, we'll see what we describe as structural momentum. And one of the things we really like, structure to our charts. We're looking for like classic pattern-based formations and structural evidence where we've got some sort of a resistance boundary that's been penetrated that gives us confidence and confirmation that price has some durability to it. The other thing in this chart that really grabs our attention is the bottom panel. And that is, and I'll just give a nod to our next speaker, Julius de Kempenaer, the relative rotation of the companies or the stock's momentum and relative strength. And so what we're looking at here in the red line is the ratio of its relative strength to the S&P 500. And the green line is basically the projected momentum, or looking at the history of the momentum of that. And so both are up and to the right, which is what we want, is that relative strength is both leading and it has positive momentum. And so, our initial thinking is the breakout above $33 on ELF gives us a initial target of $46. We can count that using a measured move technique. And then from a little bit more longer term perspective, we can get to about a $60 target using some other measures that we bring into the fold. But all said, we like to protect our capital. We don't feel like we can predict the future. We're just simply systematic traders, and we're buying breakouts with strong momentum and leadership characteristics. And in case we're wrong, we want to make sure that we've got our risk well budgeted. So we'd use a stop loss at 31.50 here. That sets up for a very solid 3-to-1 positive risk skew. And that's the sort of trade that we want to have in our portfolio.
That's a great walkthrough top to bottom, Jeff. Thanks so much for that. I really appreciate it. Julius de Kempenaer, you are our third speaker. We've now already heard a bit about the RRG, but can you just briefly, before we get started, what has this been like in 2022, particularly the last 4 to 6 weeks? It's been quite a rotation, I think, in a lot of ways, right?
Yeah, I was starting to say, you want an emotional answer? It's damn hard right now. But markets are always hard. It's never easy. By the time you think things are getting easy, that's when you should be very, very worried, I think. So I think that right now, the big picture, the macro picture, and the big sector rotation is in a transition phase. And like always, you will never know whether this is the turn that moves, is the final move up, or whether it's another bear market rally. And I think you've also alluded at some stage that bear market rallies are probably the hardest to analyze. And I think that we're in that phase right now. So that part is hard. If you talk about stock picking, you guys in the US, you're so lucky. There is tons and tons of charts and stocks. If I look at my own home market, we got probably like 50 stocks that are worth looking at. And that's hard. But in the thousands and thousands of tradable stocks in the US, there's probably always something that is interesting to look at. So my main message for this type of environment is being comfortable with being uncomfortable. You know, that's a comes out of the military, but it's probably very appropriate to being an investor right now, because once you are very comfortable, that's not good. So how did I get to my picks? Obviously, I started out with the RRGs. We decided that we are not going to show all the RRGs that I used, but that's my starting point. And what I did for today's picks is I looked at the equal weight sector rotation, because I believe that shows it's a little more honest rotation of what's going on in the market right now, not influenced by big names. And I picked the sectors that I think are currently showing the best rotations on the RRGs. And I picked one stock from each sector. And the sequence that I'm taking is going from sort of almost sure to a really big bet. And Grainger is very easy in that sense. It's in the industrial sector. Industrial sector is making a nice rotation, and what you see in Grainger is that it's breaking to new highs. That's always good, and it's doing the same on the I call that the raw relative strength. That is the pane just below it. That's exactly that. And then I got the RRG lines, which show the trends in relative strength. And what you see there is they are for a couple of months already moving parallel, and that causes a very short tail on the right-hand side of the graph. And it's now that pop in relative strength is very likely going to push GWW further into the leading quadrant, which is obviously helped by a strong performance following the breakout in price.
Very, very good. And I love there's a relative strength theme to our entire discussion, which I so appreciate from each of you guys. I'll focus on that in a really powerful way. John, we're back to you. Your second chart, we're hitting an ETF. This is XBI, which is a biotech ETF. Can you talk us through this one?
Yes. I think I mentioned earlier that we have a couple of scans that we run on 6,000 stocks. So within the past 3 weeks, a bunch of biotech stocks started showing up on my scan. Kind of came out of nowhere. They're simple scans. They're looking for setups. They're looking for low risk and big possible upside setups. So this is XBI here, obviously. So XBI broke out this is actually the end of June. It came back and retested the 50-day moving average here. And in the meantime, look what happened down in the lower panel. We have relative performance of XBI versus SPY, and we use a 63-day moving average there because that's a business quarter, and that's our strategic time period here at Asbury Research. So you not only got your breakout, but this trend of underperformance went back way farther than you can see on the chart. So now we've got some outperformance, and we have a minor trend change. Another thing, if you're looking at this chart, you can see a little double bottom here. So as we were breaking the 50-day moving average, two things were happening. One, you were getting a double bottom breakout, which eyeballing this probably takes us back to the 200-day moving average up here. And we also survived the retest. Now, the third thing that you can't see on this chart is these two lows down here are a retest of long-term lows. One was made in December 2018, the other one in March of 2020. So I was watching these two bottoms like a hawk, thinking if it holds those levels that go back 3 years, now I've got something to lean on again. I've got some risk reward again. And that's the name of the game here, as far as I see it, is finding opportunities where you can buy a stock that has good underlying technical quantitative features. And you could do it in such a way where if I bought here and I was wrong, I only risked this much. But because it's testing a 3-year underlying support level, once this thing, if it does get through the 200-day moving average, now I got a tiger by the tail. So try to risk a little so you can make a lot.
I love that. That's a great way to describe that trade top to bottom, John. Jeff, we're to your second chart, which is Dycom Industries, ticker DY. What's the story with this one?
Well, this is a Boston-based company started by some propeller heads out of MIT to create a better networking solution. It's a small cap company, And the reason I identified this company is a couple other names that are the same business, Sierra Wireless, which is a Canadian company, and also Digi International, which is a Minneapolis-based company, also in the networking gear space, have been doing very, very well. So, I believe in the wolf pack theory, and I kind of started looking at everything else in the group that I could find. And I really like classic pattern-based formations, and there's none more clear than this one in all the stocks that I could find. This is about a year plus, maybe 15-month long classic cup and handle base formation. It appears to have resolved above its neckline resistance. Stock's about $105 as we speak. That neckline came in around 101. The breakout above that level, if sustained, counts to about 138. Now, another interesting thing in this story is the relative strength. And both the relative strength ratio, the red line on the bottom panel, and the relative strength momentum, the green line, have turned up and appear again to be trending up and to the right. At the top panel, we can see structural momentum is challenging its long-time resistance, which dates back a couple of years here. And based on the price action in the stock, it seems likely that that momentum will resolve above that level, which would confirm this price action and give us a lot of confidence that it can carry forward. So, we like the stock with upside potential to 138. Again, we don't know the future. We want to, at least protect our downside with a trade setup like this. So we would establish an initial stop loss provision at about $97.50. That sets up a 4-to-1 positive risk skew in this stock, and it looks like a winner for a portfolio.
Boy, I hope when we have time at the end for discussion, we'll talk about that risk reward that you keep making a point of, Jeff, because I think that's vital here when you've seen some of these stocks that have run already to think about that upside potential. Julius de Kempenaer, your second pick, a name probably familiar to most, Alphabet. Why is this fit into your 5 pitches today?
Well, first of all, it's a communication services stock. So my first hint was the strong rotation of communication services in the equal weight version. And when I went over all the individual names inside Excel C, you can see that Google Alphabet is actually showing a very strong rotation back to the leading quadrant. It came out of leading into weakening, and now it's going back into leading. And those are usually very strong rotations. And when I look up the chart, I can see that trading range that has formed just above 105. We found strong support, which was a little cluster of highs back in the beginning of 21. And we now have that trading range between 105 and, so let's say 120, with the thrust in relative strength on the RRG lines. So Alphabet being a household name, communication services as a sector hitting long-term support. I was just looking for a leader that could drag the sector up, and this just came out as a very nice play. We probably need to push above 120 to really make it work, but I'm just going to take the plunge here and say that it's going to happen.
Communication services is a tough sector to find ideas. I feel like some of them, pretty homogenous. Communication services has some pretty junky stuff in there from strength to weakness, but not a bad idea, particularly the breakout. I like that. I like that approach, Julius. John, we're ready for your third pick, and we're looking at the technology sector broadly, the XLK. Talk us through this one.
Yeah, there's a lot of moving parts in here for me. Let's start with the chart. The chart is showing me the September 2020 benchmark high, 127.72. So whenever I see the market, whenever I see a stock, an ETF, whatever it is, hovering around a certain area, go to the weekly charts and see why. See if it's just doing it because the market's changing, or are traders trying to lean against an old level. And in this case, that's what we had here, the September 2020 high. We were really testing it since the back end of May. So all these different tests, if you want to look at them as such, kind of looks like an inverse head and shoulders pattern. And you could see the neckline is loosely where the 50-day moving average is. The other thing that was going on in the background for us is one of our models, the SEAF model, Sector ETF Asset Flows. It measures the asset flows moving around the sector space in 3 different time frames. Well, XLK showed up as one of those places that most of the money was going about 3 weeks ago. So here was our breakout. Here we actually went overweight on July the 11th because of SEAF, as I just mentioned. We had the breakout through the 50-day moving average on July the 19th. And if you scroll down, about a week and a half earlier than that, we had a breakout on the relative performance chart, started outperforming the S&P again. Part of the reason the market was so weak last year is there was no, or over the last half, there's no leadership. Tech normally leads. Look what happened here throughout most of 2022, underperformance on a 63-day basis. Started outperforming on July the 7th. I had a SEAF signal that that's where the money was going. We tested a September 2020 benchmark high for 6 weeks, and then we had our breakout. There's a lot of things giving me the same answer. So that's one of the reasons I chose this one, because you want multiple reasons, ideally in multiple time frames, to put on an idea.
And it's so interesting how the S&P is kind of approaching its June high. XLK and a lot of technology names, of course, have already broken above that high, which is which could be key. Jeff, your third chart is Jack Henry Associates. We technically bucket this with technology, but it's really one of the fintech names, right? A financial name more than anything.
Provide software and services to insurance companies and brokers and that like. The company's done very, very well. Like, kind of falls in that bucket where we would think of it as more like chicken tech, a little bit more predictable earnings stream, not as cyclical. And so Jack Henry is another one of these stocks that has made a recent all-time record high. Now, for those who haven't been reading all the text here, this is a weekly chart. We typically look at like a 3-year weekly look back to try and find these classic pattern base formations. And as we talked about in the last chart, the cup and handle is a fairly predictable one. And this is a very large degree cup and handle base formation that has resolved above its primary resistance levels and the secondary resistance level as well. So, we'll kind of throw out a level of 200 or so, give or take, as kind of being the breakout point. Stock's about 208 last look, and that breakout about 200 gives us the ability to count a measured move up to around 261, then 281 for at least a 25% upside move. Now, we like 2 elements of these momentum and relative strength characteristics. One, that we've got a very structured sort of momentum measure at the top. You can see there are 2 trend lines that are converging, and that convergence, almost like a symmetrical triangle, is being challenged. When we get big pattern structures like that that are resolved to the upside, that is something that builds a lot of confidence. It suggests very, very strong buying pressure, very strong momentum. And so we're looking for that as a confirmation here, but price is already delivering. In the bottom panel, you can see that relative strength ratio, the red line is strongly in the position of leadership. And we're starting to see the momentum line, the green line, turn up. It's not quite positive yet, but we think just the way the stock's trading right now and looking at the general trend and the pattern resolution to the upside, we think there's a high probability that we'll see at least the low end of our target range achieved. Now, again, we want to protect capital here. And as a portfolio manager, you would want to set your risk budget somewhere around 197 as initial stop loss provision. That sets up a very attractive 5-to-1 positive risk skew for Jack Henry.
It's a great setup, and thanks for talking about the weekly charts there for a minute, Jeff. That's really helpful to keep focused on the long term as when you can. Julius, your third chart is BlackRock. We're kind of still in that financial space. What attracts you to this name?
Yeah, if you think that communication services is flying all over the place, try and look at financials.
True.
I think if you would bring 2 RRGs side by side, one with the sector spiders, one with the equal weights, I think the biggest disconnect is between XLF and the equal weight version of that. If you look at the spider, the XLF, it is inside lagging and moving lower. If you look at the equal weight, it's inside improving and moving higher. So that tells me that inside financials, there's a couple of big names that are not doing so well. That's why they're dragging XLF down. But the sector as a whole is actually not too bad. It's actually moving quite in a nice direction. I'm going to give you a freebie today. Take a look at Goldman Sachs versus JP Morgan. People who are on StockCharts, look at Goldman Sachs versus JP Morgan. I think it's a fantastic pair trade. The reason I picked BlackRock is because it's a stock that came down about 40% since the start of this year. So if you want to buy low and sell high, this one fits that criteria. It dropped to a nice support level. That's the good news. It is just completing a double bottom formation, and it's coming out of this bottom formation in terms of relative strength, and that's why those RRG lines, the RS ratio and the RS momentum that Jeff is also talking about. This is actually a similar sort of constellation. This puts it inside the improving quadrant. Green momentum is already above 100. Red ratio is still below 100. That puts it inside the improving quadrant. And over time, very likely that green momentum line will pull that RS ratio line above it and push the tail of BlackRock into the leading quadrant. And I think that makes it a very interesting stock in an otherwise very spread out sector.
It's a great example with the bounce off of support. That's been a theme with a couple of these names, sort of the double bottom and now breaking above a swing high. That's a great example.
Absolutely. Absolutely.
John, we're here for your fourth pick, which is IGV. This is a software ETF. Tell us through this one.
Yeah, there's another variation on the theme here. Again, it's kind of a subset of the technology space. And here's a double bottom here. But the interesting thing about the double bottom, again, is if you went back and took a look at the weekly chart, the high from February of 2020 was 267.70. So it came back into that old high, which is an old support level. And now we're watching it to see if it can get off the dime. So it did. And meanwhile, you could take the top of that double, the intermediate high in between the two bottoms here on June 2. That's also the March 14th low. So you can call this a rectangle if you want to. You can call it a double bottom. Whatever it is, there's some basing going on. It's going on because we're retesting a 2-year high. And now we run down and take a look at relative performance. And you could see on June the 23rd, we started eking back up above the 63-day moving average, indicating you've got some quarterly outperformance going on. So you've got all these different things happening in different time frames. So if you just kind of do a rough measurement here of the width of this rectangle, if you want to call it that, takes us about to the 200-day moving average, which is 340. I'd call that the initial target. And then up above there, right here, if you go right to the right of the March 14th low there and go straight up, 356 is that high. It's the high from March 29th. So you kind of have a band there between the 200-day and that old high. I think that's a very reasonable target. And this level now that we're breaking out around 301, 300, that should be the support level that you could lean on if you want to put on a long position there.
This has been so far with the three of you guys, has been like a masterclass in price patterns and analysis. I really appreciate what each of you guys are bringing. I wish we had more time to go through all of these because there's a lot of great information here. Jeff, your fourth pick is Enphase Energy, ENPH. We bucket this in tech in a group called Renewable Energy Equipment. What is it that attracts you to this stock?
Well, yeah, there's obviously some new legislation going through Congress that favors renewable energy, and really Enphase is a leader in the solar energy area. They provide photovoltaic components to basically solar panels, et cetera. And so the stock has been in a couple year long range consolidation. Really, I would say that a level that's key here is about 222, and then obviously the more recent level in the near 290, 295 level, both have been penetrated. And so we've seen basically this range resolve to the upside. We've seen, what I would describe initially as kind of a bearish to bullish reversal develop with a deep cup base formation. All these things, kind of fit that whole classic pattern base. It's a longer term 3-year weekly chart we're looking at. And all the things are suggesting that this stock has a lot of upside potential. New all-time record high on Monday. We're looking at the top panel for momentum. Structural momentum is breaking out of a minor structure, which goes back a few months. It's again kind of one of those symmetrical triangles that has resolved to the upside. And now we have the major structure, which has 2 prior highs that have kind of held back. And what we're hoping for is that we'll see that momentum resolve above that resistance level as well. That would confirm that our suspicions are that this stock has a lot of upside potential. We can count using a measured move upside to about 360 initially, and then 390 a little bit longer term. We would definitely want to protect the downside here, even though we've got strong leadership, obviously, by the new highs. Relative strength ratio is trending positively. The momentum of relative strength has been steady and moving to the upside. So, we've got all the characteristics in place that suggest this is a strong setup. But, if we're in a bear market rally, high-powered stocks like this can get whipped back down quickly. And so we want to use something of a tight stop. And so we'll set our stop loss initially at 256, which might not seem tight to some, but given the upside, it sets up a 3-to-1 positive risk skew here. So we want to give ourselves enough wiggle room that we don't get shaken out of a really good trade. But at the same time, we don't want to throw caution to the wind, because if in fact we are in a bear market rally and the rest of the market rolls over, it's racy stocks like this where the valuations really can't be justified other than, a Cathie Wood outlook on the future. That could cause you some pain. Now, if in fact we are in a bull market that is just beginning, then this is new leadership and money will be pouring into the stocks that are leading. And so it's worth the risk in our opinion.
I love that. So that's a great summary of just the idea of stock picking in this environment, Jeff. We'll come back to that in our discussion here in a bit. Julius, your 4th pick is PayPal, PYPL. What's the thesis here?
Again, coming out of technology, one of the sectors that's doing really well. And I was just looking for stocks that were really beaten down and that were starting to show up in a positive way on the RRG of, in this case, the technology sector. And if you bring up the RRG for the technology sector, you will find PayPal kind of disconnected from the group inside the improving quadrant and moving strongly towards the leading quadrant at what we call a strong RRG heading, which means that it's traveling at a vector between 0 and 90 degrees. And then when you bring in the price chart, you see a stock that has come down about between 70 and 80% in about a year's time. And I remember very well when I was a young portfolio manager at Robeco, there was a senior fund manager at the time. The euro wasn't around. We had our weekly meeting, and we're talking about the Italian lira. And he said the Italian lira came down 95%. So there's only 5% downside risk left. And that is how I try to look at this. And the fact that it's coming out of that double bottom, I think there's a ton of upside potential here. And you see that basing going on in that raw relative strength, which is already, the RRG lines are taking a little bit of an advancement on that. I think this has good opportunities with limited risk, because you've got that 90 breakout level that will now start to act as support. So I think within the technology sector, call it the fintech sector, PayPal, I think it has very good potential. And the downside risk, I mean, come on, it's had a lot.
Great chart. And I love that discussion about the idea of a name like this. A chance to buy a good company at a deep discount potentially, which is really good. We're almost out of time, guys, for the stock picks. So we're going to go quickly through these last 3. But I want to go back, John, for your final one is healthcare equipment, XHE. What's the quick thesis on this one?
Quick thesis, this has also been an overweight on our CEF models since the middle of March. So that's the first place I will look for opportunity. So you can see it's been trying to find a bottom here throughout end of May, throughout most of June and in July. And then on July the 5th, I got some outperformance here. If you look down at the lower level, this is an emerging trend of 63-day quarterly relative outperformance versus the S&P 500. And on July the 19th is when we actually got our signal from our screen. You can see we're a little bit early here. So we bought that on July the 11th. It didn't actually get over the 50-day moving average until the 19th. So we had to sit tight for a little bit. It was going against us. But note, after it broke the 50, it came right up and took out this really important overhead level here at the Jan 28 high. It's been through it for a couple of days now. This is now a support level. So you could look at this as another rectangle if you like. I think it's kind of inverse head and shoulders. It really doesn't matter what you want to call it, but rather what the size of this is. And the size, if you measure upward, it takes you at least to the 200-day, which is around 105, or you could say to the next high. I think this is the April 4th high up here, and that's about 115. So again, it's an emerging idea. You have some places to lean on to find some risk reward. You could lean on this 95.75. If we could stay up above it for another couple of days, or you could use the 50-day as kind of a short-term area where you can put your stop. But again, this is where the money's been going in the sector space according to our CEF model. So I like to have the wind at my back, and that gives me that.
Thanks so much, John. That's a great example to finish off with. Jeff, your final pick is ADP, automatic data processing. What's the thesis on this one?
It advanced a 6-month consolidation, a double bottom base here, and what appears to be a resolution in kind of a bearish to bullish reversal. We're now challenging prior weekly closing resistance up around 249. Our view is this: a bullish inflection above that 249 would resolve this double base pattern and project a measured move to at least 306 and potentially as high as 319 for about a 28% return. All the other characteristics are in place here. We like this as a, if this, then that sort of play. Our target price, requires that we, it gives us some good upside potential. We're going to keep a tighter stop here. It's a low average true range stock. So we'll set our stop at about 238.50 for a 5-to-1 positive risk view.
Great chart and a great another great setup, Jeff. Julius, your final pick is Etsy, which has had a decent week, a nice move higher, similar to PayPal, I think, in some ways, right?
In some ways, yes. In other ways, this one is a little bit more ahead of itself. So this already fulfilled a bit of the rally. It's inside consumer discretionary, and we know that this sector is driven by Amazon and Tesla predominantly. Those two are driving XLY up at the moment, and I didn't want to go with the mainstream, just find if there's something out there. And if you look at the RRG, you'll find the tail of Etsy way up inside the improving quadrant, a very high relative momentum, and pulling RS ratio upward. That involves a risk because the RS ratio is still very low. So there is still a very good chance that it doesn't work and that we will see Etsy rolling over while inside improving and then moving back down to lagging. So that's the risk for this one. I think from all my 5 picks, this one is the riskiest. But then again, at the edge of the ravine are the nicest flowers. So if this basing can continue and if Etsy can take out, let's say 1010, where it's now pushing, maybe after a little dip, then you got a ton of upside potential here for this stock, especially when the big names will start to drive the sector higher than, you will have the smaller names that'll carry along and be pulled higher as well. So that's the reason for me to pick Etsy for this event.
That was an awesome quote. On the edge of the ravine are the nicest flowers. That was really cool. I like that one now, Jules.
It's a literal translation of a Dutch saying, so I didn't really know whether it makes sense to you guys. But
I love it. I will borrow that and give you full credit. That's a great one to keep in mind. Those were 15 fantastic picks, gentlemen. Let me recap each of those for our viewers. So starting John Kosar from Asbury Research, he shared with us 5 different ideas. One stock, ARCO, which is in the consumer discretionary stock, a Latin American play, and then 4 ETFs. So the biotech ETF, technology sector, XLK, a software ETF, IGV, and then finishing up also in healthcare with XHE. Jeff Hughes from JKHY Investments did a great job of laying out that concept of risk and reward, and you left us with 5 solid picks as well. In the consumer staples sector, we had ELF Beauty, and then 4 technology names, although one of them really more of a couple of them more financial fintech types of plays. Dycom, DY, Jack Henry Associates, Enphase Energy, and then ADP Automatic Data Processing. Julius de Kempenaer from RRG Research finishing us up with 5 different ideas in 5 different sectors based on your RRG research and really thinking about the equal weighted sectors, which was an interesting play. Hopefully we'll talk about in a minute. We had Grainger, GWW. We had Alphabet from the communication services sector, from the financial sector, BlackRock, PayPal, and then Etsy finishing off in the consumer discretionary sector. Guys, already this has been a ton of fun, and as I mentioned in the middle of your picks, you guys, each one of you are really knowledgeable. You've all been on the show before, and I think you're probably familiar with each other's work. But I'm super proud to feature all 3 of you in your expertise because it's really, really well done all around. I'd love to just talk to each of you just to sort of frame out where we're at right now. John, if I could start with you, when you've been on my show, The Final Bar, we've often talked about your Asbury 6 model, and even though we have a lot of interesting stock setups, which I think we've gone to, and some ETFs that are showing some constructive patterns, when we're looking at a chart of the S&P 500, there's a lot of question marks as to whether we continue from here or not, right? We've had this incredible run off of the June lows. When you're looking at the big picture, looking at the S&P, what is your toolkit telling you about the prospects of just blowing through 4,200 and continuing on? Or are we showing weakness in that we've run so far so quickly? How would you evaluate that?
I'm looking at it 2 ways. I look at the tactical, and then I try to look at the strategic, which for us is 1 or more quarters, and see how they fit together. So you mentioned the Asbury 6. The Asbury 6 went back to risk on July the 19th. So we have a little bit of a lead there. We're testing some resistance in the S&P 500 now. There's a wall of resistance that the reason the market's been sitting there is because it's trying to figure out whether this is where we re-engage the bigger downtrend or where we take the next gear up. I think it is going to be the next gear up. If we get through there, it'll take us to the 200-day moving average. What I've been noticing since May is options relationships, breadth, extremely negative breadth, sentiment. You can see it in the II data, investors intelligence. But these are longer term metrics that I look at to try to determine where we are in the bigger spectrum. And the last time that we were at these low extremes was in the early part of March of 2020, which of course led to the COVID lows. So I look at that bigger picture and see that the A6 has gone back to risk on. I think this is a great place with a good risk to reward type of environment now, where if you've been sitting on the sidelines and waiting to pull the trigger, I think this is a great place to do that.
Julius, if you could add to that, when we think of sector rotation on my show, we are always bringing up the RRG and trying to think through what these relationships tell us. You know, the Sam Stovall's model for recovering from a bear market low is you see leadership from 2 sectors, technology and consumer discretionary. That's how the playbook is pretty well established. Are you seeing enough improvement in those areas to feel optimistic about the future going forward, or do you see cause for concern looking at the rotation of these sectors?
I'm still cautious. I mean, if you look at the RRG that you have up right now, it's very clear that technology and discretionary are leading the market higher. Together, these 2 sectors make up almost 50% of market cap. So it's not strange that the S&P is going up. If you bring up the equal weight version of this graph, then you will find that it's a little bit more spread out, a little bit more even, and you will find financials and communication services also inside that improving quadrant. You just mentioned the sector rotation model that I talk about in Sector Spotlight every quarter, and that is, I think the cycle there is slower than what the RRG shows. So in this type of environment, I'm still in the back of my mind, I have a potential risk that this is only temporary. So that this rotation to growth will eventually roll over and not make it. And you will see the defense rolling back up. And if you look at this sector, you will find that the defensive sectors, so healthcare, utilities, and staples, they are further to the right than the offensive sectors are to the left. What that means is that, excuse me, there is still a chance that when those offensive sectors start to roll over, defense will curl back up while still inside weakening and continue that strong trend that we've seen. And last Tuesday, I did the monthly overview. Every first Tuesday of the month, I do a monthly overview. And what spoke to me on these monthly charts, when you go over each sector on the monthly chart, that obviously you had the massive decline. They all, well, majority ended up hitting important support levels, but they are now pulling back to former breakout levels where they broke support. So on those monthly charts, we're in a pullback phase. And that makes me like, okay, so if all these sectors are not going to break back above those former support levels, but they will actually start acting as resistance, then all of a sudden you'll get some more supply trickling in, which will potentially make the S&P go lower. Having said that, if we already had the low, if this was the low in the S&P, I don't think that we will go straight up. So we will get another decline, and that decline that we're going to see now will be very, very crucial for the next move that we're going to see.
That's a great way of summarizing it. Jeff, you know, it's interesting as we were going through everyone's picks, the Fed didn't come up at all. Didn't come up in terms of how we're approaching it. I'm curious, as you are thinking as a stock picker, as you're balancing the micro of looking at individual names versus the big picture, is that just old news now, or how does the potential of the Fed impact going through the rest of the year impact what you're seeing on the charts and how you're thinking of the prospects of these names going forward?
Well, there's no doubt we're in a tighter environment for financial conditions. And every day that the market rallies, it loosens those conditions. And so the Fed is laser focused on controlling inflation right now. They've made that abundantly clear. And most recently, we got a reading on the core PCE, the personal consumption expenditure index, that the Fed has really gravitated toward as their, preferred metric of core inflation. And it went up very slightly from 4.7 to 4.8. But that tells me that in the month of June, inflation continued to expand. And so as tight as the Fed is right now, at 2.25, 250, it's not doing the job that they want. And so, they've got to be looking at the rally on Wall Street saying, we're going to have to do something about this, and we're going to have to do it quick. Otherwise, we're going to get another positive uptick in that core PCE. And it's going to make it look like we're more behind the curve than we already are. So my guess is this, that the Fed will be much more aggressive on the tightening side. And there's an event that's coming up in September that I haven't heard anybody talk about, but about 1.8% of the maturities on the Fed's balance sheet mature before September 30th. And the plan, as they've articulated, is to allow those maturing securities to roll off the balance sheet. That is going to leave a mark if you're a bull.
So still a factor is what you're telling me. Unfortunately, still very, and I feel like with all of the great patterns we're seeing, still a cloud over the markets is this, an experience that not many investors have had, which is this, Fed hiking rates for the foreseeable future. That's a great summary, Jeff, of what to look for. John, as I'm thinking through some of your picks, you hit us with some ETFs, things I would generally describe as fairly offensive, some technology, some healthcare opportunities. No one picked anything in the energy sector. I'm curious how you see that sector and opportunities versus elsewhere. Now, the XLE obviously has pulled back a bit. What would you need to see to get interested in charts like DVN and FANG and others that had been making new all-time highs a couple months ago, I feel like, right?
Yeah, so we have XLE up here. I'm assuming that's a 50 and a 200 day that we have.
Yep, that's right.
And note how those averages are squeezing that price together. So it's forcing the market to make a decision. Is it going to move higher or lower? What's missing for me is, again, going back to our model, our CEF model, that was showed up in CEF, as that's where most of the money was going from January 10th to like June 24th. The S&P 500, it outperformed the S&P. XLE outperformed the S&P by 40% since then. That's crazy. But as of the end of June, that money started to come out of there and go in other places. It was going in XLV. Now for the past month, it's been going in XLK. Until I see our model shift and show me that most of the money in multiple time frames is going back into XLE, I'm not going to bite on this, because without that backdraft of assets shoving that thing higher, too much risk for me yet. So I need to see some asset flows to back up, maybe leaning against the 200-day moving average, until I would take a bite of that one again.
I love it. I love that take of it. Julius, I wonder if you can add anything in terms of, we talked about some of the offensive sectors, how they're rotating. On the RRG, energy has been sort of the outlier. It's been way on the extremes for most of the last year, but now really coming in the weakening quadrant and going down. What would you need to see to be more constructive in the commodity space, but particularly things like energy, basic materials?
Well, I mean, if we can stick with XLE for a minute, because that was interesting what John was talking about. So that tail is very clear. Now, if you bring up the holdings of XLE, so select the group XLA holdings, so the individual stocks that are in the energy sector. No, up in the groups.
Oh, sorry. Yep.
Yeah, there. So
Yeah.
select XLE. And you got a sector that's fairly spread out. Now, where the benchmark XLE is, type $1. And that'll give you your answer why we are not interested in XLE.
$1.
$1. Bam.
So this is changing the benchmark from the S&P or the energy sector to pretty much just pure absolute movements, right?
Absolutely.
Yeah.
So what we're looking at now is absolute price performance relative to something that never goes down, a benchmark that never goes down. And what you see here is that all these stocks are either already in a downtrend, according to the RRG, or very rapidly heading towards it. So when would I be interested in the energy sector? When I see this group starting to curl slowly back up. And the ones that I want to pick at that time, then I'll change it back to XLE and I'll find the strongest one in the sector.
See, Julius, every time I feel like a power user of the RRG, you school me and all these other things I can do to try to help make them more helpful. This is a really good visualization to show the weakness in energy versus other things, because other sectors obviously having a very different look at things. You know, Jeff, you had mentioned a couple times in your discussion, it came up with others as well, the importance of looking at risk versus reward. And you often talk, I mean, every time I've heard you pitch an idea, it's here's the potential upside and here's the potential downside. Why is that important? And particularly in this environment, to keep your eye on both sides of that?
Well, you know, price pays, right? It's the only thing that pays. I've been an analyst for some time now, and I can make a lot more money as trading stocks than I can by selling my research. And so that's really my focus. And if you look at my charts, my research, that's really my portfolio. These are the trades that I have on. And so I'm discussing these as though I've got real money at risk and I've got skin in the game, and I do. The other thing that I didn't really talk about as a way to manage risk, and I think it's far more important than anything I've already discussed, and that is managing your position size. It's great to be able to look at a chart and predict that the price is going higher, but do you want to be right or do you want to make money, right? And so, the idea here is if we're going to invest in these ideas, we've got to decide how much we're going to invest. How much of my portfolio do I put in every good idea I have? I've only got a finite amount of resources to deploy, so we've got to decide that. And there's a formula to it, right? We want to take a look at the volatility of every security. And we measure that by looking at its average true range. And then what we want to do is identify kind of some optimized number of average true ranges that we're willing to allow a stock to move against us before we're going to pull the ripcord and get out of it, right? And so, I've tried this many different ways. I've tested it over and over and over. And the number that I continue to come to is 2.5 average true ranges. In most instances, is the optimal number of the optimal amount of volatility to allow a specific security to engage in before you need to be worried. And so if you set your initial stop losses about 2.5 average true ranges below your entry, then and manage your position size based on that, right? Figure out, okay, what % of my resources am I willing to risk if I get stopped out? If that number is 1%, then you calculate how much that loss from your entry to your stop out is going to equal 1% of your portfolio, and then do the arithmetic to find out how many shares to buy. That's your position size. In a market like we're in today, it shouldn't be 1%. It should be less than 50 basis points, maybe less than 25 basis points.
Jeff, I hope everyone watching pauses and rewinds and listens to that last bit. That whole way of thinking about your portfolio as a money manager and not just as an individual stock investor is huge. It struck me with my time at Fidelity. I went in there thinking it was going to be all about stock picking, and we did that, but it was way more about how to construct a portfolio and thinking about all of those things that you mentioned. That was really, really well said. Guys, an hour blew by for me, and I think for all of us, and I really, really appreciate you guys each have so much to offer, and you gave us just some really, really fantastic thoughts about how to approach this sort of market. So John Kosar from Asbury Research, Julius de Kempenaer from RRG Research, Jeff Hughes from JKHY Investment Partners. Thank you guys so much for what you do and for joining us on the show today. I appreciate it.
Thanks for having us.
No problem, Dave. Thank you very much.
Folks, that's it. I want to thank our three panelists, the three J's, John, Julius, and Jeff, for giving us some time today. Really, really fantastic market commentators and practitioners that really apply what they are talking about every day. You can find more about them at their websites, and each of them have been featured on StockCharts TV as guests, as hosts, and all around. So make sure you check out our YouTube channel or StockChartsTV.com for all of our previous discussions with these three great experts. By the way, all of our previous episodes of The Pitch can be found at StockCharts.com/ThePitch. You can go back and see what stocks have been discussed every month and think about what has happened after that as the world has changed around us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good one. We'll be back to you again soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.